What's shaking in the world of finance and digital assets? Get ready for a rapid-fire rundown of the news that's moving markets and shaping the future. We've got groundbreaking shifts in institutional investment strategies, a deep dive into potential market cycles, major players re-entering the digital asset arena, and surprising corporate pivots. You won't want to miss a single second as we break down the essential updates you need to stay ahead. Stick around, because this is Bitcoin Bulletin. First up, we're exploring the crucial question of how to effectively allocate assets in the increasingly complex crypto economy. With options ranging from direct exposure to ETFs, fitting digital assets into a portfolio is a puzzle many are trying to solve. We'll break down expert insights on navigating Bitcoin allocations, especially in the wake of new institutional products, and what experienced investors need to consider. Then, we're diving into a fascinating forecast that has the markets buzzing. Could October 2025 mark the beginning of a significant downturn? We'll analyze the indicators and expert opinions that suggest a potential bear market on the horizon, giving you a clearer picture of what to expect in the coming months. And that's not all. We're also tracking a major comeback in the regulatory landscape as a prominent U.S. bank re-enters the Bitcoin custody arena after a 4-year hiatus, signaling a significant shift. Plus, get ready for a surprising strategic move from a major company venturing into Bitcoin mining. You need to know this. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. Navigating the digital gold rush, smart Bitcoin allocations. How do you position yourself for success in today's fast-evolving financial landscape? The world of digital assets presents a unique set of challenges and opportunities, especially when it comes to investing in Bitcoin. With the proliferation of cryptocurrencies like Bitcoin, Ether, and Tether, and various methods of gaining exposure such as direct ownership or through ETFs, integrating crypto into a traditional investment portfolio can feel like navigating a complex maze. Alex Chalikian, founder and CEO of Lake Avenue Financial, recently shared his expert perspective with CoinShares on the most effective strategies for approaching Bitcoin investments and portfolio allocations. The introduction of spot Bitcoin ETFs last year marked a significant milestone, opening the floodgates for greater institutional adoption, a trend that continues to gain momentum. As more investors recognize the potential of Bitcoin allocation, financial advisors are increasingly tasked with understanding its nuances, including both the promising upside and the inherent risks. Chalikian emphasizes that Bitcoin, due to its highly volatile nature and unconventional valuation drivers, is best suited for experienced investors. He points out a fundamental difference from traditional assets like stocks. Unlike stocks, Bitcoin does not generate cash flow or pay dividends, Chalikian explained. Its valuation is primarily driven by supply and demand dynamics, investor sentiment, and adoption trends. For individuals who possess the necessary risk tolerance and investment acumen, Bitcoin can offer compelling advantages to a diversified portfolio. These benefits include the potential for enhanced risk-adjusted returns, a valuable diversification element that can decorrelate from traditional asset classes, and an alternative avenue for capital appreciation. Chalikian advises that any allocation to cryptocurrencies like Bitcoin should come from capital that an investor is prepared to potentially lose, framing it as a high-risk, high-reward proposition. He notes that some advisors strategically place Bitcoin within an alternatives allocation, while others prefer to position it alongside their more aggressive equity growth investments. Regardless of where it's placed, maintaining a vigilant approach to Bitcoin allocation is paramount. The asset's notorious price volatility means its weighting within a portfolio can fluctuate dramatically. To preserve the intended weighting and risk profile, a hands-on management style is often required. Chalikian also strongly advocates for adopting a long-term investment horizon when engaging with Bitcoin, steering clear of the temptation to chase short-term gains. Chalikian's practical recommendation for Bitcoin allocation hovers between 1% and 5%. This range aims to capture potential upside while effectively capping downside risk. To illustrate the impact, he cited performance data from January 2017 to May 2024, where a standard 60-40 portfolio yielded an annualized return of 9.1%. However, by incorporating a 4% allocation to Bitcoin, rebalanced quarterly, into that same 60-40 portfolio, the annualized return surged to an impressive 16.2% over the identical period. This data underscores Bitcoin's potent return-boosting capabilities, making it an attractive, albeit high-risk, addition for suitable portfolios. Audience impact. Discussions are heating up online about the right percentage to allocate, with many experienced investors sharing their strategies and newcomers seeking guidance on managing volatility. But what if the market sentiment shifts dramatically? We'll explore the signs pointing to a potential major downturn next. Get ready to dissect the forecasts that have investors on edge about the future trajectory of the market. October 2025, the looming shadow of a Bitcoin bear market. Are the charts and indicators flashing a warning for the crypto world? As the digital asset market matures, seasoned investors and analysts are constantly scanning the horizon for patterns that predict future trends. A growing number of indicators and expert analyses are now pointing towards a potentially significant shift in market sentiment, with some suggesting that October 2025 could be the harbinger of Bitcoin's next bear market. This isn't just speculation. It's based on historical cycles, macroeconomic factors, and evolving investor behavior. Historically, Bitcoin has experienced distinct boom and bust cycles, often linked to its halving events, which reduce the rate at which new Bitcoins are created. The last halving occurred in April 2024, and if past patterns hold true, the period following a halving often sees a run-up in price, followed by a correction. However, the timing and severity of these corrections can vary. Some analysts believe that the current market, fueled by institutional inflows following the approval of spot Bitcoin ETFs, may deviate from the traditional cycle, potentially leading to a more prolonged peak or an earlier downturn. Several factors contribute to the bearish outlook for October 2025. One key consideration is the potential for profit-taking by early investors and institutions who entered the market at lower prices. As the market reaches new highs, the incentive to lock in gains increases, which can lead to selling pressure. Furthermore, macroeconomic conditions play a crucial role. If global inflation remains stubbornly high, or if central banks continue to tighten monetary policy by raising interest rates, risk assets like Bitcoin could face significant headwinds. Increased interest rates make less risky investments, like bonds, more attractive, drawing capital away from volatile assets. Another angle to consider is regulatory uncertainty. While recent developments, such as the reentry of U.S. bank into crypto custody, suggest a more favorable environment, unexpected regulatory crackdowns or unfavorable legislation in major economies could trigger a market sell-off. Investor sentiment is notoriously fickle, and any negative catalyst could quickly erode the confidence that has driven recent gains. The narrative around Bitcoin as a digital gold or an inflation hedge is also being tested. If it fails to perform as expected during periods of economic stress, its appeal could diminish. Technical analysts are also watching key price levels and indicators. Deviations from historical support and resistance levels, or bearish divergences on long-term charts, could signal a trend reversal. The sheer amount of leverage in the market is another concern. High levels of leverage can amplify both gains and losses, making the market more susceptible to cascading liquidations if prices begin to fall sharply. This could accelerate a downturn, turning a correction into a full-blown bear market. Audience impact. Online forums are abuzz with debates about whether this is a real threat or just cyclical noise, with many sharing their strategies for navigating potential volatility. But even amidst these concerns, there's positive movement in the institutional space. We're seeing major banks return to digital assets. Stay tuned as we break down a significant regulatory shift that's bringing big players back into the crypto fold. Regulatory thaw. U.S. bank reenters Bitcoin custody arena. A major financial institution makes a significant comeback in the digital asset space. In a move signaling a potential sea change in the banking sector's relationship with digital assets, U.S. Bancorp, the fifth largest bank in the United States by assets, has officially resumed its cryptocurrency custody services. This marks a significant reentry after a 4-year pause, offering institutional clients secure custody for Bitcoin and support for Bitcoin exchange-traded funds, ETFs. This development is particularly noteworthy given the bank's previous withdrawal from the space in 2022, which was largely attributed to the complexities and burdens imposed by regulations like the SEC's Staff Accounting Bulletin No. 121, SAB 121. The crucial catalyst for this strategic return appears to be a notable shift in the U.S. regulatory landscape. Key among these changes is the rescission of a 2022 advisory issued by the Securities and Exchange Commission, SEC. This advisory had previously cast a shadow over the crypto custody services offered by banks, deeming participation potentially illicit and creating significant operational and financial hurdles. The current administration's efforts to foster a more conducive environment for digital assets, coupled with eased oversight from the Federal Reserve, which concluded a supervisory program monitoring banks' crypto activities in 2023, have created a more navigable path for institutions like U.S. Bank. To facilitate its reentry, U.S. Bank has forged a strategic partnership with NYDIG, New York Digital Investment Group, a firm renowned for its vertically integrated Bitcoin financial services and infrastructure. NYDIG will function as the subcustodian, enabling U.S. Bank to deliver institutional-grade custody solutions that meet the stringent security and compliance standards expected by major financial players. This collaboration is instrumental in bridging the traditional finance world with the burgeoning digital asset ecosystem, providing clients with a regulated and secure gateway to Bitcoin and related products, including the increasingly popular Bitcoin ETFs. This move by U.S. Bank is not an isolated event, but rather a reflection of a broader trend within the traditional financial industry. Competitors such as Bank of New York Mellon Corp and Fidelity Investments have already established or expanded their digital asset custody offerings, while other major players like Citigroup are reportedly exploring similar ventures. The growing institutional demand for regulated access to cryptocurrencies, particularly driven by the success and accessibility of spot Bitcoin ETFs, is intensifying the competitive landscape. This renewed interest is a testament to the increasing maturity and acceptance of digital assets within mainstream finance. The evolving regulatory climate is a critical underpinning of this resurgence. Beyond the SEC's advisory rescission, the Federal Reserve's decision to end its enhanced supervisory program for banks involved in crypto activities has reduced the perceived regulatory burden. These policy adjustments, combined with a broader governmental inclination towards establishing the U.S. as a leader in digital asset innovation, have cultivated a more fertile ground for established financial institutions to engage confidently with cryptocurrencies. U.S. Bancorp's reentry is poised to serve as a significant precedent, potentially encouraging further expansion and innovation in digital asset services across the global banking sector. Audience impact. Industry observers are closely watching this move, with many seeing it as a strong validation of crypto's integration into traditional finance, while others question the pace of adoption. Speaking of bold moves, another company is making a significant pivot, not into custody, but into the very creation of digital assets. Get ready for a surprising corporate transformation that's set to shake up a different corner of the crypto market. Cango Inc. A strategic pivot to Bitcoin mining. A major automotive technology provider makes a surprising and significant shift into cryptocurrency mining. In a move that has sent ripples through both the automotive tech and cryptocurrency sectors, Cango Inc. NYSE. Kang, a leading provider of technology-driven solutions for the automotive industry in China, has announced a strategic pivot towards Bitcoin mining. This significant diversification marks a departure from its core business, signaling a bold bet on the future of digital assets and potentially reshaping the company's long-term value proposition. The announcement comes at a time when institutional interest in Bitcoin is growing, evidenced by the recent launch of spot Bitcoin ETFs and the reentry of major banks into crypto custody services. The decision by Cango Inc. to venture into Bitcoin mining is multifaceted. Firstly, it represents an opportunity to tap into a potentially lucrative new revenue stream. Bitcoin mining, while capital-intensive and operationally complex, can offer substantial returns, especially during periods of high Bitcoin prices and efficient energy management. Cango's existing technological expertise and operational capabilities may provide a foundation for building and managing a mining infrastructure. The company aims to leverage its understanding of large-scale operations and its access to resources to establish a competitive position in the mining landscape. Secondly, this strategic shift could be influenced by the company's assessment of the future landscape for automotive technology and the broader digital economy. As the automotive industry undergoes transformation with the rise of electric vehicles and autonomous driving, Cango may be seeking to diversify its business to mitigate risks associated with market shifts or to capitalize on emerging technological trends. By integrating Bitcoin mining into its operations, Cango could be positioning itself to benefit from the growth of decentralized finance and the increasing adoption of digital assets as a store of value and medium of exchange. The implications for Cango's long-term value are substantial. If successful, the Bitcoin mining operation could significantly enhance the company's financial performance and market valuation. It diversifies revenue streams, potentially reducing reliance on the cyclical automotive sector. Furthermore, it could attract a new class of investors interested in companies with exposure to both traditional industries and the high-growth potential of the cryptocurrency market. However, the venture is not without its risks. The profitability of Bitcoin mining is highly sensitive to factors such as Bitcoin's price, mining difficulty, energy costs, and regulatory policies. Cango's approach involves acquiring and deploying mining equipment, likely focusing on energy-efficient models to optimize operational costs. The company will need to navigate the complexities of securing reliable and cost-effective energy sources, which is a critical factor for mining profitability. Additionally, the regulatory environment for cryptocurrency mining varies significantly across jurisdictions, and Cango will need to ensure compliance with all applicable laws and regulations in the regions where it operates its mining facilities. The company's success will hinge on its ability to execute this complex operational pivot effectively while managing the inherent volatility of the cryptocurrency market. Audience impact. This move has sparked considerable debate among investors and industry watchers, with opinions divided on whether it's a visionary diversification or a risky gamble outside the company's core expertise. And that brings us to the end of our news roundup for today. But before you go, let's quickly recap the biggest stories. Don't miss our lightning round recap of the key developments shaping the market. And that's a wrap on today's essential updates. We've covered the smart ways to approach Bitcoin allocations, explored the potential for a market shift in late 2025, celebrated a major U.S. bank's return to crypto custody, and revealed a surprising corporate pivot into Bitcoin mining. Don't miss out on future insights. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, and share your thoughts in the comments below. Plus, give us a follow on our social channels for even more market intelligence.